I'm Jeremiah Boucher, a commercial real estate investor with over 20 years experience. This show is designed to help you build your business, become a better real estate investor, and help you see opportunities that will keep you ahead of the competition. This is Finding Your Edge. Hey there, Jeremiah Boucher here, Finding Your Edge, latest episode on the podcast. Today, we're going to talk about 1031 exchanges. I've been a real estate investor 20 years, executing on residential, commercial, every type of commercial asset I could invest in. And I thought I knew the ins and outs of 1031 exchanges, but I didn't. And most investors I noticed don't know all the little nuances. And since bonus depreciation has been diminishing, where you can cost segregate your property and accelerate the depreciation and then offset a lot of the capital gains or passive income that you create, we need to figure out different strategies. And I notice a lot of investors right now are more than ever exploring 1031 exchanges. So I want to get into it here. I want to give you a down and dirty guide on all the little nuances of 1031 exchanges, why they fit into the strategy, why execute on the strategy, what types of properties can you buy, what are the rules and guidelines, where most likely can you get audited, and then what's the end game with them. And I noticed this guy, Michael Landtrip, he writes a heck of a book, $50 on Amazon. I read it cover to cover. It's the playbook for 1031 investing. So let's dive into it. So what is technically a 1031 exchange? Well, it's not a tax-free loophole. It is a statute in the IRS that allows you to sell a property, an investment property, investment or rental property or business use property, and then defer the capital gains and the depreciation recapture and reinvest it into another rental property or business property of like kind, which we'll get into, and be able to defer without touching any cash, but being able to defer those profits and reinvest them into a greater valued asset than what you sold it for. So it's a tool that's a strategy to help you take your capital gains that you created in one property and then move it to the next property tax deferred, right? So everyone pretty much knows that, but it's very important to understand, why would I want to use this strategy, right? Why not just sell the property, pick up the gains, and then find another property and try to accelerate depreciation? Well, right now, depreciation, the bonus is quite a bit less. It's 40% of what the bonus was at 2022 when the Jobs Act allowed it to be accelerated to 100%. So what does that mean? Well, it means when we were buying property back in 2022, you could buy a $3 million property, and because you could cost segregation study it, you could generate up to between $1 million and $1.5 million in losses the first year by taking out all the components in that cost segregation study and then accelerating depreciation. And then we would use those. Our investors would use those. I would use those. And those losses could help offset capital gains from other sales. So in that case, you would just sell the property, pick up the gain, pick up the depreciation recapture, but then you'd have to go buy another property and find enough depreciation to offset all those gains with new depreciation losses. Well, that benefit has been drastically reduced, and it's going to get lower next year in 2026, down to 20% of what the max bonus was. And then 2027, it'll be down to zero. You can't bonus out any of that depreciation. So we don't know what legislation is going to occur, where it's been in the House or the Senate, where the Jobs Act may get reinstated, where bonus depreciation will come back. But if it doesn't, we all need to be really clear on 1031 exchanges, especially if you've owned a property for 10, 15, 20 years, or you bought a property and you accelerated the depreciation, maxing it out in the first 2 or 3 years, and then you're ready to sell it. Those are huge capital gains taxes. And one thing I wanted to bring up that a lot of people don't remember or they're not aware of. So when you sell a property, you clearly look at what was the capital gains profit. So if you bought the property for $1 million and you sold it for $2 million, that's clearly $1 million profit that you received. That's capital gains. And it's taxed at the 20% federal tax income rate plus whatever state capital gains you would have if you own the property in a capital gains state. Nevada doesn't have that. So next is, what did you depreciate during the life of owning that property? So if you did straight line depreciation, it's a commercial property. You take out the buildings, subtract out the land. So on that $1 million property, there was $800,000 of improvements. And then you did straight line depreciation where you divided that 800,000 over 39 years, or if it was a residential apartment building, it's 29 and a half years. So you roughly over 10 years depreciated $100,000 or something like that. So with that 100,000 of depreciation, you're going to have to pay recapture. So recapture is 25%, the tax. So over whatever the life of that property that you accumulated the depreciation on, this has nothing to do with your capital gains profit. You'll have to pay 25% tax on that accumulated depreciation because you got the benefit of it. You were able to use that paper loss, the phantom loss, that you really didn't have that expense, and you use that expense to offset the income that you brought in on the property. So now the IRS is saying, okay, well, you got to pay that tax back that you benefited from for the years that you own that property. The third point, and this is what most investors, I realize, don't know, is that if you accelerated depreciation and you created $500,000 appreciation in 2 years on that $1 million property, and you use the bonus depreciation rule, then in that case, you have to pay ordinary income tax. So that's 37% at this time. So if you took $500,000 of depreciation and you sold the property, so not only do you have to pay the $1 million, the capital gains tax rate at 20% long term, but then you're going to have to pay 37% if you're in the highest tax income bracket, which would be if you made $1 million profit. You'd have to pay 37% on that $500,000. That's the recapture tax that needs to be paid by the investor. So that's a huge tax bill in aggregate when you sell that property, diminishing that $1 million profit that you actually made on the property. So in that case, if there's no depreciation available on your next property that you're buying, that's where we got to look at 1031. So what are the circumstances during a 1031 that you would want to actually use the strategy? Well, number one is you maxed out the value of the property. There's really nowhere else you can take it. You can't accelerate the depreciation anymore, and you tap the value and the rents to market rents. Secondly is it's management intensive, where you don't want to deal with the management anymore. It's not a business or a property that you enjoy, and you'd like to find something more passive. Next is you don't want to spend the capital expenditures or the deferred maintenance on the property, where say you need to put in another $250,000 in paving and in fixing roofs, and you'd rather not reinvest in that property and sell it versus tapping into your cash reserves and improving the property and spending additional money on it. You'd rather find something that doesn't need those improvements for the future. Next is if you could find an opportunity that actually has better cash flows, where you can buy another property, it's going to give you a better month-on-month cash flow or ROI on the equity that you have tied up in the asset you currently own. And finally, a property that maybe has a better stable tenant base. So a property that your tenants aren't maybe as delinquent or troublesome or creating a mess, or there's issues with the tenants. Maybe you can defer and you find a 1031 exchange property that you can move those funds into with a much easier tenant profile or stable tenant base. So that's really what we're doing. We're compounding our equity without paying tax and diluting it. And we are eliminating paying or deferring paying the recapture tax when you sell a property. And this is huge. This now allows you to take the substantial amount of capital and move it into a better asset. And there's really only two reasons people sell. One is there's pain, and they don't want to deal with the property anymore for any of those reasons I listed. And the second is pleasure, where there's opportunity. There's more opportunity out there than they're currently in the current asset they own. So let's get into the key points of what qualifies for a 1031 exchange. Well, the first one is that it's like kind. So that means that you're using the property for investment purposes like rental properties or business use. And then you're buying a property for investment purposes or rental purposes or business use. There is no buying a residential property that you use as your primary residence for a 1031 exchange. You have to sell the property that's business use or investment into a business use or investment property. And what type of properties qualify for a 1031? Well, any property. So it doesn't matter if it's a residential house, if it's a piece of land, if it's a storage facility, a mobile home park, a office building, industrial, retail, anything, small bay industrial, car wash. All of these assets qualify as long as they are used for business or investment purposes. So if you're buying a vacation home, technically that does not qualify. Now there's rules around that where you can buy a second home that you use as a rental and then you can qualify, and I can get into that after. But regardless, you cannot buy your primary residence, or you cannot buy a second home with 1031 exchange funds, and you can't sell your primary home or vacation home in 1031 exchange it. So it's very simple. You can invest into a construction property as well. So there's three types of 1031 exchanges. The first one is a straight 1031 exchange, but very few people actually do that. That means you have a property, someone else wants your property, you want their property, and then you just swap. That is the most rare circumstance that happens out there, because rarely do you have a property at the same or equal value, same or greater of value than someone else, but really it would be equal. And then the other person would want your property and you would want theirs. So the most common form of a 1031 is a 1031 deferred exchange. That's what 90% or more of people do. And then the third type is a construction exchange, where I don't really want to get into that. I think it's very hard to execute on, and there's similar rules to a deferred exchange, so I'll share it here. But to dive into a 1031 deferred exchange, this is the rules that we've all heard, right? Where you're selling the property that you have, and we call that a relinquished, the relinquished property, and you sell it and you find a replacement property. It has to be at the same or greater value than what you sold for. So if you sold your property for $2 million, you have to find a property that is at least $2 million or greater for investment purposes. Now, if you're looking to do a construction project, the same goes for that. But the timelines that are critical are 45-day identification period. So as soon as you sell that property, the day it closes, you have 45 days to go identify 3 properties, or up to 2 times the amount of the property that you sold. So in this case, you sold your property for $2 million. You could find 10 $400,000 houses that were rental houses for $4 million. That's the max that you can identify. So pick at least 3 properties. You can pick 1 if you want, but 3 is a good amount that you have some options. And those are the identified properties during that 45-day period. Do not miss that period or you do not qualify. And then who do you tell for this qualification? Well, this is a key player in the whole strategy, is your qualified intermediary. I can refer one to you and I'll put one in the comments there. And that's a very important player that plays a role in this strategy, where there's a lot, it's still the Wild West. These qualified intermediaries are really the person that are going to hold your funds. So as soon as you sell your property with the relinquished property, then instead of giving it to the funds to the title company, do not do that, or you disqualify for a 1031. Those funds need to immediately go from the title company straight to the QI, the qualified intermediary. And that person, that firm, they hold your funds. And that's where you identify those properties by giving the address, the parcel number, and the legal description. That would be the bulletproof way to do it if you do it that way. And now they have at least 3 properties that you are considering buying. And then the next timeline that we all have heard, I'm sure, is 180 days to close. So from the time you sell to the time that the closing is of the property that you're buying with the funds that the qualified intermediary is holding is 180 days. You cannot miss that. And if you do a 1031 mid-tax year, make sure you file an extension, because if the filing date for taxes, it's April 15th, if the 180-day period is not up before that period, then you got to extend out your tax return, because the year you did the sale, you need to file it on your taxes. You did a 1031. And if you didn't do that, then you disqualify. So get an extension on your taxes if you're doing a 1031. And for a construction 1031 exchange, it's similar to that, but you have to have significant construction progress or it completed within 180 days. That's the challenging part for me, is being able to time a property that you sold and having substantial development on your property that you're buying. That's tricky. 6 months is a tight timeline. And if you don't meet that criteria, then you don't qualify and you can't use those funds for the construction property. So be careful, but you can do it. That means you can buy vacant land. So you can 1031 from a rental property into a piece of land, but that land needs to be used for investment or business purposes. You cannot use it for building your primary residence on it. And remember, it has to be of equal or greater value of the property that you sold. So big mistakes that I see with people doing a 1031 exchange is number one, taking funds out of the sale. Now, you can take funds out of a sale of a property and still 1031 the remaining balance, but you can't touch the money that you're going to be 1031ing. You have to give that directly to the qualified intermediary. And if you do take out the funds, you do need to know that you will be taxed on those funds. So if you had a $1 million profit and you had $500,000 of depreciation recapture, and you had bonus depreciation on that 500 grand recapture, that's 37%. You're going to have to pay tax. So if you take $100,000 out of your profit, you're going to have to apply 37% taxes to that 100 grand because the IRS taxes you at the highest tax bracket portion of the sale, which would be the recapture in this case. You'd be paying $37,000 of taxes on the 100 grand. And then when you eventually sell and cash out in the future, you would have to pay the remainder of the taxes. And those other funds can go into that investment property. In that case, the IRS calls that boot. So any money that you get, the term is called boot. So how do you choose a qualified intermediary? This is important because in 2008, there was the Land America Trust or Land America Company. It went bankrupt, and it was one of the top 5 biggest qualified intermediaries in the country. And they were buying bonds, and they were using leverage to buy bonds. So they were getting an interest return on the money they were holding. It was roughly $400 to $450 million of investors' 1031 funds. And with the great economic crash, that caused the company to go bankrupt, that those bonds weren't performing and their debt called due. So in that case, because Land America Company was holding the deposits in their name, they owned the bank accounts ultimately. Now, they had a segregated account for each 1031 investor, but they were the owner of the bank account. So they were then considered an asset of the company. And then in bankruptcy court, they lost everybody's money. And they were even taxed on some of the issues that came up after those bonds were sold. So that was a bad situation where investors had a significant amount of capital, very significant, and they lost all their money because their QI or qualified intermediary own the bank accounts. So what you want to do, and this is where I found a really good qualified intermediary, you want to make sure that they open a trust or escrow account with you or your LLC, whoever's 1031 exchanging, is the beneficiary of the trust. That's really important. So not only is the account segregated or separate in its own individual account, but you are the beneficiary. Now, you don't have the right to do anything with those funds except for cancel your 1031 and get your money back because they are the trustee of the actual account. But you as the beneficiary keep that asset off of the company's books, and that protects your money if anything were to happen financially to that company. And then in turn, you would get your cash back. So make sure you focus on that because qualified intermediaries, they're not licensed. They're not required to be bonded. They're not required to be insured. They're not required to be certified. So it's a very loose game. So if a realtor or an escrow company refers them, make sure to do your homework and ask them, where does the money sit? What type of account does it sit in? And am I a beneficiary? And is it a trust or escrow account dedicated to me? Very important. All right, so what are some of the passive assets? So say you don't want to actively go out and buy your own investment property or have to find a deal. You want something more passive. So there's 3 buckets that you can invest in passively with a 1031. First one is a DST, Delaware Statutory Trust. This is a special trust out of the state of Delaware where in the IRS, I think it was in the early 2000s, qualified that trust was able to be a qualified property that you could exchange into, but it's not a property. You own a fractional interest of a trust that qualifies as a 1031 exchange investment. This applies to the same rule where the value of what you're selling needs to be of greater or equal value to what you're buying, and you're buying a fractional interest of the trust. And then there's a trustee or someone controlling the DST, and they are required to distribute all the profits to the investors. And it's a very popular strategy where large DST firms will acquire properties and then create a DST, and that's where a lot of 1031 investors use that option. I think they're pretty low yields. You have no control, but if you are looking for something completely passive and you happen to see a good opportunity, it's a valid investment vehicle to go into. The next one is triple net properties. So you can find Dunkin' Donuts, Pizza Hut, Bank of America, McDonald's, all these triple net properties, meaning retail properties that are single tenant typically, and the tenant pays the taxes, insurance, maintenance, repairs, everything. It's a very hands-off property, and ideally you're looking for a 5, 10, 20-year lease with that property, and it's very hands-off. And as long as you meet greater or equal to the sale price of what you sold, you can 1031 into a triple net property. And then the last one is a tenant in common property. This is where you can divide up a property and get a portion of the deed or of the title in a fractional interest, in its own ownership interest in that actual property. So you could have 4 different property owners on the deed or title, and you each own your pro rata share of that property on the actual deed. So that way you qualify for a 1031 and you can reinvest all your proceeds into a property that has other investors in it, and it's actively managed by someone else running the TIC. This is a strategy we've used at Patriot many times where investors need a 1031. So we will create a TIC and they will reinvest in a portion of our property, and it meets the needs, and it's a nice investment property that they don't need to go out and find, nor do they need to manage it in the future. One other advanced tip that you cannot do with a 1031 exchange is if you own a property in an LLC with 5 partners, you're a passive member of the partnership, and that partnership sells the property. Unless all the other members of the LLC want to do a 1031 exchange with their portion of the LLC, then you can't 1031 from one LLC interest into a property. That's not like kind. You own a unit share. You're not a property owner. You're not on the deed of that piece of real estate. So you can't be in a real estate partnership with a bunch of other partners and then exchange into a new partnership LLC. That does not qualify as like kind property. That's where you'd have to sell a property yourself, and then you would have to go into a TIC. And that point, you would be able to buy in as a fractional interest from one property, investment property, to a fraction of another investment property. And then lastly, so how do you own property generationally and not pay tax, where the 1031 is actually tax-free? Well, it's when you die, right? So it's a long game for sure. But if you continually keep buying property and keep stepping up the value and keep getting more debt and borrowing and buying more and more property, you could start with 100 grand and end up with $30 million of property over a 30-year period of time if you continue to step up and sell into high-performing assets that keep appreciating and you're not paying tax along the way. So how do you not pay tax? Well, as upon the time that you pass away and the property is owned in an LLC, and all your heirs or any of your partners, everybody gets a step up in basis. So at the time of your passing, the IRS still allows where you value that property, get an appraisal, and then at that point, the basis is now the value that upon your death. And so if the property's worth $30 million and your basis in the property after all the depreciation and after all the 1031s was only $1 million, then $29 million is now tax-free because your basis now is $30 million in that property, and all the heirs benefit from that. So that is how the rich stay rich, and that is how you can build generational and legacy wealth with the 1031 exchange. So I hope that was clear. This was a very technical episode, but that was everything I know about 1031 exchanges. Check out Michael Landstrip's book. I think he does an excellent job lining this up, and he gets more into the details of how taxes are calculated and how depreciation works. It's very simple to read, and he's a highly technical lawyer, so it's a skill for him to be able to put those in layman's terms. So look at doing a 1031 if you are selling a property with a lot of depreciation recapture and you have a large capital gain. Right now, that is an ideal strategy, and it may be in the future the only strategy if we don't get bonus depreciation back. And feel free to reach out to me, my team, patriotholdings.com. We can break down what properties we have available for 1031, and we can highlight an advisor to you, either a qualified intermediary, tax advisor, or a real estate attorney or accountant that will help you break down what your tax liability will be when you sell. So good talking to you. I hope you enjoyed it. Hope I didn't ramble too much and you are super clear on 1031 exchanges. I will use them and I hope you do too in the future, and keep finding great properties and investing. See ya. For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening to Finding Your Edge.